Choosing the best life insurance plan isn't always easy. There are a lot of factors to consider, and many of those factors are hypothetical, which makes life insurance a bit of a gamble. You may not have all the facts right now, and so you'll have to play the odds. Here's how to stack those odds in your favor and make an informed decision with as many known factors in play as possible. Step 1. Find out how much life insurance you need. Start by writing a list of your debts and payments. You'll want to list off your loan debts first, including the balance and payment. Then, make a list of the things you pay for each month other than loan debt, including utilities, food, gas, phone services, internet, etc. Once you have all your monthly expenses listed out, calculate the total. After your total expenses are calculated, then it's a good idea to figure out how much money per month your family needs to keep living the lifestyle they're living now. Account for things like holiday and birthday gifts, going to the movies, soccer team dues, piano lessons, vacations, and other things of that sort. Total your debt, bill, and lifestyle expenditures, and once you have that estimate, it's time to get with a professional. They'll help you figure out big picture ballpark figures using your monthly calculation, and how much life insurance you'll need to keep your loved ones afloat for the long haul. Step 2. Find the right kind of insurance. The right kind of insurance is the best life insurance for you. Term, whole life, and universal life policies each come with advantages. Term life is only good for a defined amount of time and only covers your life. When the term is up and you are still alive, the benefits are typically gone. There are no payouts or lifetime perks. However, term life is typically cheaper than other options and perfect for people with dependents who are living on a budget but wanting coverage in the event of catastrophe. Whole life is one form of permanent life insurance that uses an estimated 120 years of life. Basically, if you take 120 minus your current age, that's the number of years it's good for. The carrier estimates your life insurance premium for each of those years, calculates a total, and then divides by that number of years. That's your premium. The premium is relatively stable, but you pay for years you may not live to see. Universal life is the other form of permanent life insurance. With this kind, you pay for each year as it comes. As you continue to age, your premiums increase as well. This is due to the fact that covering yourself as you get older gets expensive. You have more health problems, take more medications, and require more care than younger counterparts. This kind of insurance may seem scary. However, if you use an indexed universal life product properly, you can not only cover yourself and your dependents when you die, but accumulate cash passively through investments. This would offset the increasing cost and even provide retirement income with tax advantages. Step 3. Find the best price. Now that you've found the best life insurance, it's time to find the best policy and carrier from which to buy it. Considering your age, activities, and overall health, your premium will vary from one company to another. So, if you choose an IUL, certain companies have parameters in place that will increase the speed at which your money would grow. But that's just one example. If this information overwhelms you, don't try to do this on your own. Our unique life insurance professionals can search the country for the best policy and carrier for your individual situation. Our agents can assist you with any questions you have at no cost and no obligation. How's that for a good investment? Don't wait until the worst case scenario becomes reality. Click the link in the description to get started. If you're interested in empowering yourself and taking control of your situation, subscribe to our channel and put more health, life, and financial tips on your radar. Thanks, everyone!